Okay, good morning everyone from Geneva. I'm very pleased to have been given this opportunity to speak at the 8th APDC, especially after having had the pleasure of speaking at the very first APDC in Africa earlier this year. Please allow me up front to thank the Spring Rain Global for this opportunity and privilege to address the delegates today. As you heard, my name is Kingombe. I'm the managing partner of 4IP Group, an impact investing advisory boutique located in the French-speaking part of Switzerland. Okay, so I hope you can see the slides. This is a second slide. So let me start by outlining the structure of today's presentation. I'll start by introducing to you different types of impact investing, why I believe that faith has the potential of becoming the future of impact investing. How do you start implementing impact investing in practice? How do you, and I'll also showcase a few case studies and good practices. And based upon this, I will draw a few conclusions and policy recommendations on the next steps forward. I hope you can still see the next slide, which is so basically the rise of entrepreneurial approaches to solving social and environmental problems, the availability of new hybrid forms of social organizations, the appearance of new generation of entrepreneurial philanthropists create a perfect recipe for innovation. Models of entrepreneurial social finance are being expressed in Africa through newly formed venture philanthropy and impact investing funds. The figure one that you can see in the slide basically illustrate the landscape of social finance using the metrics of the degree of engagement and the kind of financial return anticipated. Venture philanthropists and impact investors engage actively with their investees compared to the traditional grant making or the social investment industry. Typically, venture philanthropy uses grants, but may also seek to recycle capital by using other tools such as loans or devices such as quasi-equity. Impact investors would choose financing tools that at the very least preserve capital, but preferably give modest risk-adjusted rates of return to their investors. Venture philanthropists and impact-first investors sit within our broad understanding of entrepreneurial philanthropy, as they use their capital for primary social purposes, and they are in a position to put capital at relatively high risk. The next slide. So in describing the venture philanthropy and impact investing model, most practitioners would agree on a set of general characteristics, operating principles. Venture philanthropists and impact investors generally support a small portfolio of organizations at any one time, preserving a deeper engagement than what might otherwise be possible with a large number. These characteristics lie at the very heart of entrepreneurial philanthropy, distinguishing it from the most traditional funding models. It is not unusual for a venture philanthropy or impact investment fund to accept one or more places on the board of the organization, or to attend board meetings as an observer, to add value in governance and strategy. This is not the normal practice of passive social sector funders like grant makers. So the table that you can see on the screen, table 2, summarizes the matrix of options open to entrepreneurial philanthropy practitioners in their choice of investees, their investment sector, financial tools, return to investors, non-financial support, the depth of engagement, and exit graduation. In other words, impact investing can be categorized based on the investor's preference and motivation to prioritize either financial return or impact. So the financial first investors seek to optimize financial return with a floor for social and environmental impact. This group tends to consist of commercial investors who search for investment vehicles that offer market rate returns while yielding some social or environmental good. Meanwhile, the impact first investors seek to optimize social or environmental returns with a financial flaw. This group uses social or environmental good as a primary objective and may accept a range of returns from return on principal to market rate. This group is willing to accept a lower than market rate of return in investment that may be perceived at higher risk in order to help reach social or environmental goals that cannot be achieved in combination with market rates of financial return. And both investors could also be working together in the so-called layered structure. These layered structures are created when the two types of investors work together, combining capital from impact first and financial first motivations, blending different types of capital with different requirements and motivations. In these deals, impact first investors accept a sub-market risk-adjusted return, enabling other tranches of investment to become attractive to financial first investors. And this symbiotic relationship allows financial first investors to achieve market rate returns and impact first investors to leverage their investment capital loss, achieving significant more social impact than they would otherwise if investing on their own. In 2019, the Global Impact Investing Network, GIN, undertook a project to deepen engagement with the faith-based investment community. The purpose of the engagement was to understand how to best support more conscious and deeper impact allocations within the faith-based investment portfolios. And the GIN team did this through a faith-based investing survey. An ensuing GIN paper in 2019 outlines the following key insights from the survey, interviews, and convenings that they undertook. According to the GIN faith-based investing survey, 82% of the faith-based investors respondents target risk-adjusted market rate return, as opposed to only 18% willing to entertain below market transactions. This is understandable in a sector that has traditionally relied on growth of endowment assets to fund grant-making activities and pensions. So if the investment purpose is to expand established operation, then the likely investment is loan from a wide range of investors, as you can see in the first row on the table. On the other hand, if the investment purpose is to bridge finance to proven revenue generating activity, well, then the likely investment is a loan from existing supporters or community finance intermediary. If the investment purpose is startup financing for new area of operation with potential for very high profitability, then the likely investment is equity-like investment with likelihood of strong financial return. And finally, if the investment purpose is startup financing for new area of operation that is unlikely to lead to a strong probability, well, then the likely investment is none, and there's a need for a grant instead. On that background, it is important to emphasize that the potential deal is large enough to warrant the high transaction costs associated with impact investing. Also, that non-profit has sophisticated enough understanding of finance to navigate the investment process, including the staff as well as the board, and that there's enough staff and board members are not trapped in a bifurcated worldview, and that an anchor investor exists among current supporters, and finally, that non-profit has the time and capacity to see the deal done in investment that are sold and not bought. Okay, so the impact investing is on the rise globally. Based on the GIN's annual impact investor survey in 2020, in 2020, $750 billion of asset under management was categorized as impact investing, with remarkable growth over the last decades. And the GIN's 2022 market sizing report estimates that the current size of the global impact investing market now has reached 1.146 trillion of US dollars, revealing its considerable growth in recent years. However, impact investing formed only a small fraction of the global capital market. In fact, estimates shows that the broader sustainable finance landscape, which includes environmental, social, and governance integration strategy stands at $35 trillion of asset under management in 2020, up 4 trillion from 2019, according to the Global Sustainable Investment Alliance. These ESG strategies have taken up an important share of the overall global asset and wealth management industry in recent years. And at the end of 2020, at about 33% of the 103 trillion of asset under management. So the term sustainable investment is defined as an investment approach integrating environmental, social, and governance factors into the selection and management of investment. And the slide that you can see in front of you just basically shows the 8 different forms of sustainable investments. You have exclusions, norm-based screening, best in class, ESG integration, ESG voting, ESG engagement, sustainable thematic investment, and impact investment. And the figure present a classification of these approaches. All approaches can be categorized according to the sustainability focus that you have. Okay. So the term impact investment was only coined in 2008, but how its rise has been meteoric and its global promotion well resourced, as just mentioned. Pure philanthropy is always going to be constrained since donations are a one-way flow of capital. The promise of impact investing, and I guess that's the reason why I'm speaking to you today, is to create social value by investing in socially focused enterprises with sustainable business model, which, when successful, preserve capital and even offer a return on the investment. So returns are reinvested in new ventures and create a virtuous circle of socially minded investment. While the term may be new, the practice is much older, and impact investing has its roots in program-related investment, a device pioneered by the Ford Foundation in 1968 that allowed endowed US grant-making foundation to invest their corpus in support of quasi-commercial entities that potentially fulfill the foundation's charitable objectives. In 2009, the global impact investing network, the GIN that I just referred to before, was launched by JP Morgan and Rockefeller Foundation and USAID as an impact investing movement's advocate. In 2011 report from JP Morgan, the GIN estimated 4 billion of potential impact investing for the following year, up to 1 trillion in the coming decade. As I just told you, was reached in 2021, 1 year later due to the COVID pandemic. So impact investing offered the same but more, a business-like approach to philanthropy where capital could be recovered or even enhanced by investing in social businesses. So we have arrived at a golden age of responsible investment, a time when even the world's largest private equity investors are among the ESG's most enthusiastic boosters. Unfortunately, while the enthusiasm for solutions that required limited or no financial return or sacrifice, or perhaps even better deliver impact alpha, are at an all-time high, there seems to be a profound disconnect between the intensity of the rhetoric, the so-called 33 or 35 trillion of US dollars of asset under management that I referred to in the previous slide, and the relative lack of interest we see in the corners of the impact first universe that may require one to accept more modest and concessionary financial returns. Impact investing is a natural extension to continue deepening the impact that their investment portfolio can achieve, giving the vast wealth held by faith-based investors. Activating their assets towards impact can lead to substantial contribution both to Agenda 2030 and the Paris Climate Agreement. So why do we need to change the current narrative? Because Christians own more than half of the world's wealth. It also happens to be 200 to 300 times greater than what is donated philanthropically each year. Capital at this magnitude can influence to help bridge SDG financing gap and finance the COP21 commitments. And yet, Many faith-driven investors are content to let others determine where this money is invested. Too often, they passively profit from portfolios that run counter to their belief. The problem is not money. The problem is whether the money believes in impact. And I, for one, want to contribute to change this. So why should the secular world care about faith-based, what the faith-based world is doing? Well, since the very early steps of investing, religion has been the first motivation for social responsible investment. A common way of defining faith-based approach is investing in a way that does not violate investors' religious belief. This approach manifests in various subterms such as faith-based investing, morally responsible investment, faith-consistent investment, value-aligned investment, biblically responsible investment, or even Sharia-compliant or Islamic investment. As such, faith-based investing is regarded as a special subset of social responsible investment. And despite historic pathfinders, faith-based investors have since lost their position as thought leaders in the social responsible investment movement. The investment industry has seen massive growth, as I've just shown you in the previous slides, in thematic and impact investing in recent years. And yet faith-based community has not been keeping up with the industry, let alone leading in it. Faith-based investing is often regarded as old as religion itself. The impact of faith-based investment decision reached public knowledge through early activism, through shareholder engagement on social and environmental topics. Several divestment movements have since been driven by religious investor institutions. And a concrete example can be found from the early engagement of religious institutions in the fossil fuel divestment movement starting in the early 2000s, followed by the announcement of the Church of England in 2015 to divest their £9 billion investment fund from the most heavily polluting fossil fuels. Accounts of faith-based organizations pioneering the community development impact investing field are also common. For instance, the Oiko Credit and the Genesis Community Loan Fund are faith-based impact investing organizations. Historically seen, faith has always dared to take a leading role when it comes to social development. And today, faith continues to have a substantial potential to create change through investment. More than 7% of the global land surface is owned by religious institutions, speaking of the sheer volume of wealth steered by these actors. As recent GN report illustrate, while no specific figure has been estimated for total asset held by faith-based investors, there's a strong evidence that illustrate that vast accumulation of wealth and most likely represent trillions of global asset under management. And in addition to the already existing wealth of these actors, faith-based investment has seen increasing growth in recent years. John Silverling, the executive director of US-based Christian Investment Forum, estimate that $260 billion of US dollars are invested in alignment with biblical principle, and yet very little information going beyond estimation of the total sum exists today. Interesting, nearly a quarter of the approximately 90 biblical responsible investment funds in the US have been launched after 2015. Clearly, religious institutions have significant economic resources at their disposal, and it should be emphasized that money is only part of faith contribute to sustainable development. Religious groups, institutions, individual-run school, social agencies have significant political power, and at institutional level, they are able to reach a broad audience through their own networks as well as through interfaith coalitions, economical groups, or faith-based transnational. And the reason that faith can be so powerful for good and sometimes for bad is to personal and communities transformative power, which money can sometimes but not always assist. And additionally, the international recognition of faith leaders, especially the Dalai Lama and the Pope in Rome, can be seen as a symbolic resources with powerful influential voices. So faith-based organizations have always used their assets to fund their mission. And in this way, faith-based actors can also act as an example for aligning value with actions. An additional asset for faith-based investors is their approach to long-term holders with typically long investment horizon. With this in mind, faith-based actors can play a leading role in aligning investment with long-term returns that do not come at the cost of sustainable development for short-term gains. Step 1 to 2 on the slide is basic investment for signaling investment approaches such as negative screening. Sorry. Let's see where I am in terms of time. Okay. Yeah, okay. So such as negative screening, best-in-class ESG integration that can signal to the market that some investments are considered more or less desirable depending on their business. Such mechanisms have limited investor impact given they only invest in the secondary market. Step 5, that is stewardship, active ownership through voting and engagement as shareholder can influence the practices of companies, potentially leading to positive impact at scale. This is an approach allowing an investor to have impact in public market. And then finally, step 6 to 7 is really financing investing in private market investments. Here you have faith-based investment means investing without violating investors' religious belief. So faith-based investors can range from small community consisting of few members to large organizations that encompass several communities. And many faith-based investors are small to medium-sized organizations who have assets but limited investment capacity. Example of Christians exclusion areas, as you can see. So for the Catholic tradition, negative screening of activities related to arms, tobacco, human rights violation based on international convention is derived from the belief that in the well-being and common of people and society. For instance, the faith-based organization Catholic Missionary Oblates of Mary Immaculate excludes 6 to 7% of the US stock-listed companies based on these principles. Table 2 basically depicts example of how Christian values are linked to the SDGs. One aspect that might still be unique to faith-based investment is that for something is evangelism. Evangelists denote the approach of Christians seeing it as their mission to evangelize and convert everyone to Christianity. In investment, this takes the shape of, for example, investing in Christian companies or Christian entrepreneurs. While acknowledging the diversity of faith-based investors, one can nonetheless identify a few characteristics shared by most actors in the space. Number 1, low risk appetite and market rate return expectation. 2, dependency on external advisors and managers. Number 3, acceptance of higher management fee for faith alignment. And number 4, a desire to collaborate or join communities. The different organizational setups of sizable faith-based investors can typically be categorized in one of the 3 areas: pension funds, denominations and endowment, organizations with a philanthropic mission, such as foundations and development agencies. Graph number 1, visualize a typical investment decision-making process of faith-based investors. It implies a rather sophisticated decision-making process, which can be found in organizations that have a large pool of capital. The key parties involved is the board, the ethics committee, the investment committee, and the investment team. While the 3 approaches are not only pathway to construct a more impact-driven portfolio, research and case shows that these have been the key drivers in the implementation process. Another way faith-based organizations can align their investment with their value is through being an active owner and engaging with their investees. So exploring faith and values. So you have faith values are the guiding moral and ethical principles derived from religious belief and teaching. It's rooted, so they are rooted in the doctrines and scriptures and tradition of faith and religious community. They provide a framework for how faith communities understand the world, make decisions, and interact with others. And faith values are integral to the identity, practice, and mission of faith-based organizations. So many faith holds belief, values, and officially approved statements related to the use of money, social justice, care for the earth, and other topics of importance. And many faith groups have financial assets and approved investment policy statement and guidelines that govern the oversight and management of faith assets. Exploring the faith and values, this basically illustrates, for example, how Christianity are based in biblical teachings on generosity and stewardship, parables, and teachings of Jesus about wealth and responsible and Catholic social teaching. Faith consistent investing is intentionally aligned all assets that are available to invest with what your faith community wants to achieve by integrating your faith values and belief in foundational investment governance documents and processes, as this roots investment decisions and translates value into traditional investment languages. Okay, let me just, in interest of time, since I was only allocated 25 minutes, I'll skip this and just go to my conclusions quickly, if you allow me another 2 minutes. Yeah, so basically the commonalities between faith-based investors and impact investors' interest in the SDGs suggest opportunities for collaboration to pursue shared social and environmental goals. Evidence from Median's faith-based investing survey and the 2029 annual impact investor survey suggests that faith-based investors and impact investors are not yet aligning around shared interests. And faith-based investing survey respondents stated a top challenge the organization face in pursuing impact investing is finding and sourcing investment aligned with their faith tenets and value. We have a huge opportunity, and this movement has only just begun. There are 582 million entrepreneurs worldwide, and we estimate 150 million are Christ-following entrepreneurs. If you add up all Christian organizations ministering to entrepreneurs across the world, they are only serving 0.3% of the entrepreneurs. This means that 99.7% of Christ-following entrepreneurs don't have a go-to community or resources to help them in this journey. We want to change that. The GIN survey respondents were asked about what would help them or other faith-based investors allocate more capital to impact investing. Over 50% of respondents indicated research and data on financial and impact performance of impact investment. Number two, convening with and learning from other impact investors would be significantly helpful. This is exactly what we hope will be the outcome of today's conference. And it will be important to engage influential faith-based investing peers and faith leaders, such as the delegates of today's conference in Bangkok, Thailand. And last but not least, according to the GIN's 2019 annual impact investor survey, fund managers who raised capital from faith-based investors were asked about their experience. And similar to the faith-based investing survey finding, the top challenge cited by fund managers was that their fund did not target specific impact themes of interest to faith-based investors. There could be, for example, a mismatch in the impact offered by fund managers and impact sought by faith-based investors, the so-called LP. So the development of faith-based investor product may be needed. Okay, and with this, I thank you for your attention, and I look forward to any questions that you might have during the panel discussion later today. Thank you very much for your attention. Bye.